Hello, fellow Rebel Capitals. Hope you're well. We got huge news. The Dow is down 1,000 points. We're going to be discussing this as well as the Fed rate cut decision and whether it was dovish or hawkish. We're also going to be talking about global governments, basically collapsing. When you look at what's happening in Germany, what's happening in France, what's happening in Canada. And then we're also going to be talking about new retail sales, which leads to a discussion about what's happening in the auto sector. We're calling it Automageddon. This is something you definitely want to tune in for. So sit down, buckle up, guys. Let's rock and roll. Getting over to what happened with the Fed? Well, you guys know they cut by 25 basis points. That was no secret. If you saw my discussion today with Fed guy Joseph Wang, he was predicting this, and it was like a 95% probability based on the CME Fed Watch. So no surprise there. But what shocked the markets was the Fed came out very, very hawkish. So it was a hawkish 25 basis point cut. And when I say it caught the market off sides, I ain't joking. The last time I pulled this up, it was about 10 minutes ago. The Dow was down by 1,000 points. Now it's down by 1,100 points. And by the way, this caps off a 10-day losing streak, the first 10-day losing streak since 1974. And talk about going out with a bang, where on that 10th day, you're down by 1,100 points. I hope you bought some puts on the S&P 500 the other day when they were super cheap. I was this close to doing it, and I didn't pull the trigger, and now I'm kicking myself. But anyway, getting into the key talking points here. Federal Reserve Open Market Committee cut its overnight borrowing rate, 25 basis points. So now we're in the range of 425. So I call it Fed funds now at 425. Back to level where it was in December of 2022. I would also like to point out that it's back at the level that we saw in December of, you guys know what I'm talking about based on yesterday's video, 2007. You got it. The similarities are just really unbelievable. Scary, for sure, but unbelievable that we started with a 50 basis point cut September 18th. We started from 5.25. Then we followed up with 2.25s to end the year. Exact same things that happened in 2007. We talked about that a lot last night, so I'll shelf that for the moment. All right. Oh, by the way, did I tell you that Jeff Snyder is going to be joining us here in about 20 minutes? So you guys are definitely going to want to stay tuned. Jeff is going to come on the live stream and talk about how these global governments are collapsing in real time due to a lot of things, especially economic conditions. So you're definitely going to want to stay tuned to hear from Jeff Snyder live here in about 20 minutes. But getting back to the key talking points here, today was a closer call, but we decided it might be the right call. Wow, I didn't know he said that. Jeez. Josh, did you know? Were you watching this by chance?
I was looking at like the live alerts while it was going on.
What's that?
I was watching the live alerts.
Yeah. Now, okay. So I thought he just came out with some hawkish statements about next year as far as, maybe the Fed's not going to cut as much as you think. I didn't know that he actually made some hawkish statements about today, saying that it was a close call. I mean, that's a pretty bold statement. Why would he say that? You know what? I'm just thinking this through out loud, obviously. He has to want the market to come down. He has to. I'll bet, he's no dummy. He realizes that a lot of the aggregate demand in the economy is due to asset prices being at insane levels. I mean, he sees what's going on with Fartcoin. He sees what's going on with the S&P 500. He sees what's going on with MicroStrategies. And he's got to be sitting to himself saying, look, letting a little air out of the bubble wouldn't be a bad thing. To me, because every single word is premeditated. in these Fed speeches when they get done with the FOMC decision. So I can't imagine that Jerome Powell just said that off the cuff. That, oh, yeah, by the way, you guys thought there was a 99% probability that we would cut today. Actually, it was a very close call. We were thinking about pausing today. It was about 50-50. He doesn't just say that just on a whim, is my point. He had to have said that with intention. That's really what I'm trying to say. Okay, next key talking point. The Fed indicated it would probably only lower twice more in 2025. Oh, this is nonsense. How on earth can Jerome Powell predict what is going to happen in 2025? Give me a break, especially when you look at 2008, right? I mean, again, using that as a comparison, the GFC, not to say that 2025 is going to be the exact same, like a carbon copy of 2008, but we know that that is a probability based on exactly what we're seeing today, not just with the interest rate cuts, but the economic data. You know, back then inflation it wasn't just sticky, it was going straight up. So the narrative was the exact same back then as it was today. Obviously, Jerome Powell has studied that. He's not oblivious to the things that we talk about on this channel. I'm not saying he watches the channel, but he's not oblivious to the topics of discussion, let's say, and the data that we try to emphasize in our analysis. So he knows what happened back then. So he knows that in August of 2008, everybody was talking about a reacceleration of inflation and the Fed having to hike interest rates. And then 2 months later, you're at zero and doing quantitative easing. And within a year later, you're at a quarter of negative inflation, in other words, deflation. He knows that. So to think that he can predict 2025 to the degree to which allows him to say they're only going to cut twice in the next 12 months and say that with any confidence whatsoever, I think is completely ridiculous. And if that's the way the market is interpreting it, I think that's your opportunity. Remember yesterday we were talking about when you get really good at investing, I don't know if I'd even put myself in this category, but when you get really good, it's all about expectations versus probabilities. And the spread between those two is your opportunity. All right, let's get back to this here. I was going to play Leisman, but you guys know what he's going to say. Here we go. So this is a great chart. I was actually going to cut to this, but I was going to cut to the Fred chart. We can just use the one here from CNBC. Again, do you notice anything similar here? This is GFC cycle, and this is today's cycle. Literally identical in every way so far. Every single metric, it is identical. All right, you guys get it. Moving on here. Assuming quarter point increments, officials indicated 2 more reductions. Oh, you've got to be kidding me. So now they're talking about they're talking about dropping 50 basis points in all of 2025, and then another 2 basis points, or excuse me, another 2 cuts of 50 basis points total in 2026. Give me a break. So for this, let's go back to that Fred chart, because here's where I get really frustrated. Just show me a Fed rate cutting cycle that corresponds to an inversion of the curve where they cut gradually, where they start by 100 basis point cut. And by the way, if the economy is so sound and so solid to where you're 100% sure that you're only going to cut by 50 basis points in the next 12 months, then why the hell did you just cut by 100? I mean, come on now. Come on. How can you take him seriously? I just cut by 100 basis points in the last 2 months, but I can assure you I'm only going to cut 50 basis points in the next 12 months. This is just total nonsense. And again, look at the last few cycles. Show me the cycle here that was combined with an inversion of the curve where they cut gradually. It's not a thing. It's not a thing. You never see a gradual cutting cycle. You always see wet and wild. That's what we talk about on this channel all the time. It's always the Wile E. Coyote dropping of interest rates. It's not the slow and smooth. So what you're doing there, Jerome Powell, is you're telling us this time is different. You're saying that with confidence. Now, is there a 0% probability that this time is different? No. But if you're going to argue this time is different, which are the most dangerous words in economics and investing, you got to back it up, man. You got to back it up with some rationale. And I don't see why this time. I mean, you can sit there and say, well, inflation is sticky. Well, great. And it was sticky in 2007. It was sticky in 2001. Right? Where you say the unemployment rate is low, George. Yeah. And unemployment rate was low in 2007. I mean, everything is the exact same. There's nothing that makes this different as far as the data. Now, again, it could pan out in a different way, but so far, you got 95% of the stuff, 95% of the data coming in the exact same way. So I don't know how you could come to the conclusion that there's a 99% probability that this cutting cycle is going to be gradual as opposed to wet and wild, Wile E. Coyote. Okay, getting back to the key talking or the article. Let's you guys get it as far as the details of what happened. Bottom line, 25 basis point cut that was extremely hawkish as far as rhetoric, to the point where the market was caught way off guard here. Let's look at what is happening with asset classes. I mean, this, talk about a good thumbnail, Josh. This facial expression, Josh, cut and paste or copy and paste this thumbnail. That's a great expression. Just cut this guy's face here. We can use that on a thumbnail later. Okay, so this says it all, right? As far as the emotion involved here. Dow down 1,123 points. And again, it's not just a one-day thing here. This is a 10-day losing streak, and who knows what happens Monday. And the first since 1974. And I'd like to remind you that 1974, not a great year for the S&P 500. And editors, you can go ahead and throw up a chart on this tomorrow. But if you look at the S&P 500 back in 1974, that was a bear market where we had a decline of 50%. And I want to point out that 50% decline was nominal. So this was a time of very high inflation. My point, in real terms, as far as purchasing power, the decline in the S&P 500 would have been a hell of a lot more than just 50%. Now, let's go let George Gammon take a shellacking here, because as you guys know, longer term, going into 2025, I like the TLT, the long end of the curve. But boy, oh boy, did it get taken out to the old woodshed today. Look at this. 10-year treasury yield up 12 basis points to 4.5. So there's so much going on here, guys. This is crazy. So now we've got a total uninversion of the entire curve. I don't know what maybe the 2s and 5s, something like that. But as far as the 10-year, that is now officially higher than Fed funds. I'm assuming it's higher than, yeah, it's got to be higher than the 3-month, obviously higher than the 1-year, higher than the 2-year. So we've likely got a reinversion or an uninversion of the entire yield curve. Just happened within the last 2 hours. And you guys know from watching my videos, historically, that's when the stuff hits the fan. That's when, you start getting the economic data sour and you get that narrative shift. But let's look at I'm getting ahead of myself here. There's so much going on. Let's look at a chart of the S&P or the Dow, excuse me. And look at this 10-day decline. Whoa. That looks like a chart of that's like MicroStrategy level volatility here. Look at that. Let's just look at the last 3 months. Jeez. So right here, we're just, yay, stock market all-time highs. You know, CNBC, they got they're jizzing in their pants, you know, jizz in my pants. And they're like, all-time highs. You know, they're just completely euphoric. And then all of a sudden, they get the right hook from Tyson. You go down a little more, a little more, a little more, a little more, and then beep, down by 1,200 or 1,100 points. Jeez. Now, to be fair here, yes, it's down massively, but you're still just at a level where you were, what, prior to the election? I mean, it's not like this is we're in dire straits here, but this could be the start. I mean, there's anything like 1974, then this is the beginning of dire straits. I can assure you, because remember yesterday we were talking on the video about how the entire U.S. economy is pretty much propped up by asset prices, housing, S&P. So if you get the S&P going down, let's say it does go down like 1974 by 50%. It's not a prediction, but if it does, we talked yesterday about how that impacts aggregate demand. In an economy of 70% consumption, I don't know how you have positive real GDP if the market's down by 50%. And if you are worried about the deficit, then what does that do to tax receipts? Tank. All right, so now let's go back to the bond market. And so what does this mean? And what I'm talking about is the 10-year being up by 12 basis points in the matter of a couple hours. What does this mean for the dollar? Okay, Josh, give me the drum roll. We need some sound effects on these live streams. But we talked about the dollar exploding higher yesterday. And a lot of people gave me crap in the comments like, George, the dollar didn't explode higher. Well, I wasn't talking about that day. I was talking about over the last couple months going from 100 to 107. But if you thought I was exaggerating slightly or using clickbait, look at today. Maybe I was just being a little ahead of schedule, let's say. Because today, boom, 108, 108, up 1%. That's a huge move in the dollar. A huge move within the matter of just a couple hours. So I'm not going to rehash everything that we talked about yesterday on why the dollar going up put so much pressure on foreign economies and how, and the key component there, if you didn't watch yesterday's video, is dollar denominated debt, and then also commodities are priced in dollars. This puts tremendous pressure on countries like Japan. Therefore, they have to sell whatever's on their balance sheet to get those dollars they need. That usually is yen, and that makes the dollar go even higher, which exacerbates the problem. And then you just get this feedback loop to the point where they have to not only start selling yen, but they have to sell things like gold. So I'm not going to go into it extensively, but just the Reader's Digest version that you guys need to be aware of is, don't think that the dollar yen doesn't matter for you because all you own is gold or all you own is Bitcoin or something like that. No, the dollar yen absolutely can have a massive impact on the price of gold, because you get to a certain level, you have a liquidity event. And you guys know from living through the GFC, what happens to gold, what happens to all asset prices other than the dollar when you have a liquidity event. Well, basically the correlation goes to 1 and they tank all at the same time, including gold. Now, again, that's the buying opportunity. I get it. But my point there is liquidity absolutely impacts domestic asset prices, gold, Bitcoin, etc., real estate, and dollar yen or dollar euro or dollar pound, dollar CAD is definitely impacts liquidity. especially if it keeps going up, 110, 120. So we're going to have to watch this like a hawk. So, boy, there's so much to say. In fact, before we bring in Jeff Snyder, let's go ahead and look at what is happening to gold. That's down 2%. That does not surprise me at all. Oil, if I had to guess, probably no impact on that. Actually, maybe down. No, I'm going to pass on oil. I don't think we'd have much of a price move. There you go. Okay, really nothing. Crypto, I would assume, got shellacked. Oof, yeah, 5%. Doge, down 10%. I wonder what happened to Fartcoin. Josh, pull that up really quick. That's obviously the most important. Forget Jeff Snyder. What's going on with Fartcoin? So go ahead and pull that up real quick to see what what the quintessential meme coin did as a result of this hawkish talk by the Fed. And while you're doing that, let's go ahead and bring in my good buddy Jeff Snyder here.
I do have a live update on Fartcoin, and I did update the drum roll.
Okay.
I don't know. Can you guys hear that?
I can hear it. Jeff, can you hear that drum roll?
I got to stop it now. But Fartcoin is immune to a recession.
That's really cool.
I can tell you that.
Okay, what happened to Fartcoin?
Up on the day. It's almost at $1 billion.
No. It's up. What did it do in the last 2 hours?
It's up. It's immune. It's recession immune.
So there you have it. You heard it first right here on the Rebel Capitalist Show. Fartcoin is a better form of money than Bitcoin, or maybe even the dollar. Who knows? Obviously, I'm joking. Okay, so let's bring in my good buddy Jeff Snyder. Jeff, can you hear me? Nope. Josh, you got to work on Jeff's audio. I don't think he can hear me.
I don't know. Let me call him.
Okay. So, I don't know. Technical difficulties on these live streams. You guys got to bear with me. Okay, while they're doing that, let's go ahead. I can't believe that Fartcoin is actually. Oh, is Jeff up now?
Oh, okay. I told you to give me a heads up.
Oh, yeah. Okay, so now he's up. There he is. Jeff, can you hear me?
Hey, George.
Hey, buddy. So what is going on? Well, I want to get your opinion on Fartcoin, on the Fed's interest rate, the real important topics of discussion here. But let's go into these global governments collapsing as a result of the underlying economic conditions. I mean, you just did a video on this. So give us your thoughts, because this is big news.
Well, I mean, what is it that James Carville said back in 1992? It's the economy, stupid. And that's what dictates a lot of the economy is within relatively narrow tolerances. People don't care. They can go back into their own little corner and argue over certain ideological issues. But there's nothing that unites people so much as an economy that doesn't work. And so you see one place after another. I mean, it started with, go back to France earlier this year. Germany's government's collapsed. Canada's about to collapse. Japan's ruling coalition fell apart. Same thing.
When they say collapse, what do they mean by that specifically?
Well, I mean, in a parliamentary system, it means the current government, which is usually formed out of a coalition. Okay. The coalition no longer agrees with it, so they can no longer maintain the current prime minister and administration. So the government collapses, which means the administration goes into a caretaker. And the caretaker is just simply a bureaucrat or a technocrat that just as the name implies, takes care of everything until the next government can be elected and come to a conclusion.
Got it.
So, I mean, it just, it's one place after another. The thing is, it's not partisan, George. You know this. It's not partisan. It's not one side or another, because you've seen so-called conservative governments that fall, like the United Kingdom. The conservative government there had been in power for well over a decade. They got thrown out of office. And then you go to the opposite side where you have a bunch of left-wing governments or leftist governments that have been thrown out too. People are just pissed because the economy is not what they thought it was supposed to be. Everybody said we recovered. It was red hot. Everything was great around the world. A couple years ago. What really happened was that everybody fell behind, or really got left behind, by lost purchasing power and prices. And for a while there, most people, I mean, people are really patient. They were willing to say, okay, I got hammered by consumer prices. I lost a ton of power. I got impoverished,
Right.
but you keep telling me that everything's good and I'll get that back somehow. If the labor market truly was robust in all of these places, and I'm including the United States here too, because we had a change election in the US, a very big change election in the US for the same reason. So everybody's okay. We're willing to put up with this so long as we think that there's a plausible pathway to get some of that purchasing power back. And then as the economy weakened throughout 2024, when it was supposed to be just fine, people started to realize, oh crap, I got made poorer and I'm never going to get that back. And of course they got angry, and they got angrier as people, all the incumbents and people in power kept telling them that, shut up, everything is just fine. I don't want to hear your complaints. You're a bunch of whiners. And that's what really doomed all these people, is the fact that they wouldn't listen. They wouldn't hear the complaints that we got from regular folks and regular people who were saying, look, this is not good. And every incumbent around them says, screw you, shut up, everything's fine. I've done a tremendous job. That's what really, I think, really lit the fuse, is like, people are, okay, I'm not just going to sit here and take it and you tell me everything's just fine when I know that it's not. And so that's what really has lit the spark, is that, look, you can't sit there and tell me everything's fine when everybody knows it's not. You got to at least admit there's a problem before we can even start to talk.
Yeah, and I think Trump just poured fuel on the fire when he talks about, as an example, he talks about a potential 25% tariff on Canada. Then they completely, you had a fragile system to begin with because of the underlying reasons that you're discussing. But then you throw on a 25% or possibility of a 25% tariff, and then things really fall apart fast. You got the finance minister, that's quitting, basically saying that Trudeau's policies are completely backwards, and that if
she almost said they were childish. She said this is not a serious thing.
Yeah, basically shit's gonna hit the fan if we do have these 25% tariffs and the current administration isn't taking this seriously. Therefore, I quit. I mean, there's a lot of things that are going into this that lead to basically economic contraction.
That's part of it, but I think, she quit because it's, the rats are leaving the sinking ship. I mean, everybody knows that the Trudeau government's unpopular. When they do have an election, they're going to get shellacked anyway.
Yeah.
So it's sort of like an excuse, like, okay, I got to get the hell out of here because, get out while the getting is good. Yeah. And again, it always comes back to the same thing. Everybody knows the economy's poor.
What's interesting is she gives him the finger when she leaves. That's what was interesting,
That's another sign of, holy crap, they screwed this up. And really, it's the unpopularity goes back to, look, Bill Clinton got away with a lot of stuff because I could feel your pain, right? If politicians had said, you know what, we're doing the best that we can. We were presented with really unique challenges that were absolutely immense. And we did, we experimented, we did a bunch of stuff. We didn't really know what we were doing. And you know what, there was really some downside to it. We know not everybody had a good time. It wasn't a really great economy. It was the best that we could do. Now we're going to try to fix it. If anybody had said that, they had a better chance of surviving these elections. But nope, everybody went in the other direction. Like, nope, can't admit anything was wrong. This includes the lockdowns and all the pandemic restrictions and everything else. We can't admit that we were wrong in any way, shape, or form, which is just making people even angrier.
Right. So if you're saying that your belief is that the United States is in the same bucket, has the same economic issues, there's just a slight lag. The rebuttal that you're going to get is, Jeff, you don't know what you're talking about, because just look at the economic data. It is true that China is going through basically a GFC. It is true that all these governments are collapsing. We'll grant you the fact that it's because of these underlying economic issues, but that's not happening here in the United States. We've got 3% GDP growth. We've got the unemployment rate, although it's going up, it's still at historic lows, let's say. We've got all this new positive mojo because we've got the Trump administration, we've got Doge, we've got the Federal Reserve coming out today, Jerome Powell. Yes, they dropped by 25 basis points, but look what he was saying. He's saying they were actually, it's like a 50-50. As to whether or not they were going to cut. And now he's saying that the economy is so good in the United States that they're only going to cut by 50 basis points in 2025 and then into 2026. So over the next 2 years, they're only going to cut by another 100 basis points, 1%.
Sure.
I mean, if that's not confidence in the U.S. economy,
Oh,
I don't know what is. So I know you always talk about globally synchronized economy, but maybe this time it's different, and the United States can continue to grow at a 3 or 4% clip when all their other trading partners and all the other developed economies are collapsing.
Yes, there's a lot of stuff there, George. Let's start with the Fed. The Fed actually didn't say they were confident in the economy. What they said is they're not confident in consumer prices and inflation. Big difference there. They know that the U.S. economy, despite GDP, we have an employment problem here too. It's really starting to build up, especially when you realize that a lot of people, hundreds of thousands of workers have dropped out of the labor force. So while the official unemployment rate might be 4.2%, which is, as they'll point out, historically low, if you adjust for labor force dropouts, it's almost 5% already.
Okay, so let me explain that real quick, Jeff. I'm sorry to stop you right there, but just so the audience is following us there, what you're saying is, yes, we're at 4.2. Yes, that's triggered the SOM rule. We're up from 3.4. That in and of itself is negative. But what you also have to do is look for the adjustment of the labor force participation. And because the labor force participation has gone down, that you could argue that makes the unemployment rate artificially low, where if you readjust for a normalized labor force participation, that takes us up to maybe 4.7, 4.8.
Yeah, and I think that part of the problem is that people are dropping out of the labor force because there's nobody's hiring. And nobody hiring is actually recession, the recession process. It's not layoffs. Layoffs come at the end.
Right.
It doesn't matter where you're looking throughout history. When businesses stop hiring people and that starts to lead to a pileup of unemployment, whether official or not, when we say you have to adjust for labor force dropouts, what we're really saying is that people stop looking for work because nobody's hiring. And if the BLS happens to call you up and say, are you looking for work this month? And you say, well, no, nobody's hiring. You drop out of the official labor force, which means you don't get counted in the unemployment rate, even though you're not looking for work for actual economic reasons.
Did they pick that up in U6?
No, you drop
That's
out
not
entirely.
Even up in U6. Okay.
So if you're not looking for work and you haven't looked for work in the last 30 days, you're not part of the labor force, and therefore you drop out of the statistics entirely.
Okay.
And this is something you see at every recession cycle inflection, is that unemployment begins to rise and the labor force participation usually flatlines, doesn't really go lower. That's a post-2008 phenomenon. But the participation rate starts to fall off because population still grows because nobody's hiring. Yeah. And so that's the common trait that we see in labor markets around the world. And that's what the Federal Reserve implied. The Fed says we see the labor market is actually weakening. We think it's relatively stable, but we're not really sure. But what we're now more concerned about, because the Fed has an institutional bias toward inflation, is that because consumer price disinflation doesn't happen in a straight line, and it's a very discontinuous process, we're on an upswing. So the Fed dots adjust to the latest CPI. Going by the Fed is not a good way to go through this, because think about how we got here over the last year. Go back a year and a month ago, a year and 2 months ago. The Fed was talking about, we're probably not going to have any rate cuts whatsoever in 2024. We might get one, maybe two at the most. And then what happened? CPI started to dip down, and they said, oh, we're going to start cutting. We're going to be able to cut rates. And then earlier part of this year, what happened? CPI started to rise again. And what did they say? Maybe one or two rate cuts in 2024. We might even have to start talking about rate hikes. And then what happened? The labor market got weak. We had more disinflationary CPIs going through the discontinuous process. And what did the Fed do? The dots came down. The Fed did a 50, and everything adjusted to the last CPI report. Where are we now? And we're in the same process where the dots are looking at the last couple CPIs that are back on the upswing. And they're saying, we're not really confident in disinflation anymore because we don't really understand where disinflation is coming from. We're simply reacting to the last data that we have in our hands. So throughout that process, just look at the trend here. You look at the dots from one meeting to the next, or one SEP release to the next, and it looks like they're going down and up and down and up and down and up. But really what you're seeing is they go up, then they go down, then they go up, but not as much, and then they go down a little bit further. Then they go up, but not as much, and then they go down a little bit
lower
further.
Highs, lower lows.
So over time, the trend is this way. Going down, just like the market is. So the Fed is not really a reliable source. They're just simply reacting to what the latest data is.
Okay, so
the bigger issue here that you mentioned, George, is decoupling.
Okay.
The idea that the U.S. economy is an island unto itself, full of all of these wondrous strengths that will insulate it and inoculate it from weakness that's happening around the rest of the world. And show me an example where that's happened before. In a globally synchronized system. I mean, Jim Rickards and I had this discussion previously. I asked him whether or not we could actually define economies anymore by national boundaries, because there are strong links between, it's not just between economies, there really is no individual economies anymore. Look at the correlations between just the US and Canada, for example. There are immensely strong correlations where if the Canadians are incredibly weak in their labor market, the unemployment rate in Canada got up to nearly 7%. Is there a chance that the U.S. economy is going to do something completely different? Well, if history is a guide, unless something truly is different this time, that's not the case. And to be clear, I'm not saying Canada's weakness causes weakness in the U.S. That's not what we're really saying, is that these global factors that are becoming more and more visible and evident outside the U.S. will eventually show up more stronger inside the U.S. too. We've already got the hiring problems, so that's started the process. So as you said, George, we're just kind of bringing up the rear for the global system.
Why do you think we see this phenomenon from a mechanical standpoint, or this correlation between all of these global developed economies? Is it because although we're a net importer, we still export, call it 600 billion per month? And if you have a decreasing demand for the global economy for U.S. exports, that goes down by, let's say, 100 billion a month. Now we're at 1.2 trillion off of GDP every single year. Is that mechanically why everything is so synchronized, or how would you explain it?
That's part of it. I mean, trade is definitely a big part of it, though less of one for the United States, because trade is not as important at the margins in the U.S. economy or the U.S. part of the global economy as it is in other places around the world. So you look at, like, for example, Germany and Japan, they're heavily influenced by trade flows. So that makes perfect sense why they would have such a globally synchronized. I think it comes down to, George, the fact that economies transcend national boundaries. You have large multinational companies that respond to global conditions, not specifically U.S. conditions. So if you have a large multinational company that's seeing weakness in other parts of the world, and they say, shit, we got to start cutting back on our costs. It doesn't matter where they cut their costs. They can cut their costs in Europe. They can cut their costs in Taiwan. They can cut their costs in the United States. And since U.S. labor tends to be more expensive than other places around the world, you think, well, unless I really need an American worker, might as well lay off some American workers, even though the weakness isn't specifically in the United States. And that's a gross oversimplification, but that is the mechanical link where you have a highly interconnected system where things that you wouldn't necessarily believe, or factors you wouldn't necessarily think are impacting domestically here in the United States, actually do make actual impacts and inform decisions at a higher level.
Yeah, and probably what's more importantly is the interconnectivity of money. So what I mean by that is, and of course you're Eurodollar king here, but what I mean by that, Jeff, and I'm sure you're going to get it, but for the audience here, just to explain, is what you're talking about is risk increasing. So perceived counterparty risk, perceived risk in the financial system, in the Eurodollar system, in the monetary system, through these banks, they're looking at these real economies and they're saying, wow, they're seeing the same stuff we're seeing. And they're like, risk is going up, 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 up. And if risk is going up, the circulation of dollars is going to decrease. The amount of credit that's being created on net balance is decreasing. Therefore, the currency supply is decreasing. And then you've got all these Eurodollar international banks that are tightening their belt. They're reducing their risk. That's why they're buying treasuries. But they are connected in many ways to the United States domestic banks. So then you have the real liquidity, not the Fed liquidity, but the real liquidity in the banking system getting tighter and tighter and tighter. So you've got the economic deteriorating from the bottom up, but then you also have the liquidity deteriorating from the top down.
Yet I think that's one of the reasons why the U.S. ends up lagging the globally synchronized cycles, is because in the initial phase, when risk aversion hits, like you said, George, you go into treasuries, you go into some safe U.S. dollar denominated asset.
Right.
And so while other parts of the world get starved of liquidity and dollar funding, You don't see the same thing initially in U.S. funding terms. So there's a preference for U.S. dollar denominated assets. So U.S. companies aren't pressured the same way that, say, companies around the rest of the world are, even though multinationals are reacting to the same types of situations as anywhere else. So there's sort of a preference in that initial phase for the U.S. system, or at least the U.S. part of the system, which means that there isn't the same level of urgencies to take real economic action to do something about the downside.
Yeah.
So
And
again, it's not decoupling; it's a difference in timing.
Another thing too, Jeff, that we have to realize is on yesterday's video and earlier today, I was talking about how the United States economy has really been propped up by asset prices. So that you're playing a very
Not
risky
lately.
game of musical chairs. But my point there is, if you actually think about the interconnectivity, it's not just U.S. balance sheets that are impacted by U.S. assets. It's also balance sheets of Japanese banks, right? So they had to go out the risk curve because their dollar funding costs go up. So they have to go into CLOs that they really dove into, which compresses the corporate spreads. And so everyone thinks that there's no risk, but it's just these banks that don't have an alternative but to go out the risk curve to capture that spread, so they're not losing P&L every single month. But that brings in, let's say, the balance sheets of all of these international banks and companies. Therefore, if you have that decline in, let's say, the S&P 500, that goes into commercial real estate, that impacts the CLOs, and then that blows a hole in the balance sheets of all of these other banks outside of the United States, which negatively or exacerbates the negative problems that they're having to begin with.
Yeah, what you're really describing is a discontinuous nonlinear process, right? It's a back and forth. It's always difficult. It's opaque. It's hard to put your finger on the pulse and say this is exactly what's happening. And because it's a large, complex system, it doesn't happen all at once in the same place at the same time to the same degree.
Right.
And so you're kind of looking around at, okay, this part is flashing a warning, but this one looks really good and okay. So maybe this one's an outlier and the okay part's really the baseline. Or maybe this one's, we got a warning over here, plus a warning over here, plus a warning over here. And this is the only part that looks okay. And you just start to see the, negative heat map start to heat up, the red spots start to heat up. And you realize, okay, the inflection has turned. And if we're talking about how complicated it is, the Federal Reserve has no chance. The Fed has no chance to identify the factors that are going to be determining the direction of anything, right, let alone something like the labor market in the U.S.
Or do anything about it. Let me push back again. You always talk about how the long end of the curve especially is not about supply of treasuries, but it's all about growth and inflation expectations. And I think you've got literally decades of data to back you up on that. But we just saw that the 10-year treasury yield spiked by 12 basis points in just the last 2 hours. So if the long end of the curve is typically correct and it's predicting growth and inflation expectations, especially in the US, then the long end of the curve, forget the Fed, the dummies, the smart money is telling us that growth and inflation expectations are increasing for the US economy, which contradicts what you're saying as far as this globally synchronized downturn.
Well, first of all, I don't think you can make any of that kind of determination on a short run basis to begin with, because the market doesn't change on a daily basis and say, okay, today we're going to have massive growth and inflation expectations, sell all the treasuries. And then tomorrow they say, holy crap, it's deflation, buy all the treasuries.
Right.
On a short run basis, look, what's really happened today is actually at the front end of the curve, including what the sell off at the long end. What happened was the Federal Reserve did what the Fed has been doing over the last year. Getting 2 rate cuts has been a long and torturous process where the Fed, as I started out, they go back and forth, back and forth, back and forth. And whether we like it or not, the Fed does have the ability to influence the short end of the yield curve. And so when you're setting at the long end, yes, it's growth and inflation expectations, but you also have to factor not only Federal Reserve policy, where short end rates are, but also the uncertainty regarding the future path of those short-term rates. So even if you think short-term rates are going to go lower and that the Fed will get its head out of its ass and act on that at some point, they introduce an element of uncertainty over that future path that has the effect of raising rates, because the uncertainty over the future path of short-term rates goes much higher. So again, the process that we took to get to this point, just to cutting rates, was all over the map. A high degree of uncertainty about short-term rates because the Fed could never decide itself. We don't know where rates are going to go up and where they're going to stop. So if it was that torturous of a process getting to rate cuts, why would it suddenly go smoothly when we start rate cuts? If anything, the Fed's going to introduce even more uncertainty over the rate cuts because they're even less certain themselves.
Right.
So what I think is happening at the long end of the yield curve, again, setting aside short-run fluctuations, is that the near-term uncertainty about the Fed's path has gone way up, largely because of the Federal Reserve itself.
Yeah, and I'm sure you've done the research, but we just talked about this, and I've talked about it on a few videos lately, where people believe this time is different than the last cycle, let's say during the GFC, because they think the narrative now is way different than it was in 2007. But what I like to point out is September 18th, 2007, when they cut by 50, the CPI was right around 3.5. And you fast forward, and you fast forward to August of 2008, and we get to 5.6. 5.6. So think about what the rhetoric on CNBC and what the talking heads would have been saying back there as far as the Fed being way off sides. And they're cutting into a red hot economy, Jeff. Look at this. The CPI went from 3.5 to 5.6. And then, I mean, the Fed's got to hike rates going into the end of 2008. I mean, this is a no-brainer, right? Or
that's what they were actually talking about
in the 1970s. And we all know how that played out.
That's what they were actually talking about. You go back and read the transcripts in 2008. They said, yeah, there's some banking stuff over here. We see weakness in the unemployment and unemployment. But have you seen the CPI lately? They were definitely discussing as late as August 2008, raising the federal funds rate for 2008. Because like I said, there is an institutional bias at the Fed, and an understandable one, against inflation more than the downside. And it really goes back to, what is the old story from, was it Jay Powell or maybe it was Ben Bernanke, where he was talking to the janitor at the Federal Reserve, and the janitor pointed to the picture hanging on the wall, or the Bernanke or whoever the Fed chair was. Let's say it was Powell. He said he pointed to the picture hanging above the conference room desk, and he asked the janitor who that was. The janitor had no idea what his name was, but he knew he was the guy who let inflation get out of control. So that's the institutional bias at the Fed. They're still stuck in the great inflation. And they're always thinking that if we don't do something, the whole Volcker myth and the legend of Volcker has institutionalized that inflation bias to the point where any little minor movement in the CPI, we better react to it in that exact way. And that's why you have this high degree of variability in the Fed dots and everything else over the last couple of years.
Maybe it was Arthur Burns. He was probably,
well, that was the picture he was hanging on the wall, was Arthur Burns.
Yeah, that's
nobody knows what his name is, but they know his picture because it was pretty. Everybody saw his face.
Yeah, he smoked the pipe, and Volcker smoked the cigars. Yeah. So Jeff, let's circle back to the global governments collapsing here, because the US dollar, and we just pulled up this chart, was up significantly over the last few months, going from 100 up to 107. But today, in the last 2 hours, we go 107, and now we're north of 108. So how does that exacerbate the problem of the global governments collapsing?
Well, I mean, that adds more pressure to the economies that are already experiencing it anyway. And it's one of the most visible symptoms of dysfunction, right? If you're just a layperson sitting in France or even Canada to an extent, and you see, things are not really going well, and you see the Canadian currencies dropping against the US dollar, it's one of those things where you say, this too, on top of everything else, it just adds more to it, even if people don't realize why the currency is going up or down. And again, short run basis, it's as much speculators betting on interest rates or even portfolio flows than anything else. But there is a longer term trend there that matters. And there are currency crises that are developing in certain parts of the system as we're speaking. Brazil is maybe ground zero for what might be the next one. Brazil's in a complete mess. And the Bank of Brazil, the central bank in Brazil, has been intervening in the currency markets since Friday, just trying to keep everything relatively orderly. And it's not going all that well. And that's, Brazil is not unique. India's been doing the same thing. India is short somewhere around 70, 80 billion US dollars in non-deliverable forwards, which I still have to laugh because that's the absolute stupidest way to try to get a handle on a currency. So it's not like one or another. We're seeing, like I said before, you see these trouble spots start to develop and deepen around the map. And it's like, okay, this is something we need to pay attention to. And while it's understandable to think that has nothing whatsoever to do with the U.S., has nothing whatsoever to do with the Federal Reserve or, President Trump coming in with a bunch of business-friendly policies, which they may be business-friendly and they might be positive, but by the time they get enacted, will be many months down the road, assuming they could be effective to begin with. It's worth paying attention to all of these trouble spots, including the collapse of governments around the world, because that does matter. Whether we realize it or not in the short run.
It matters to U.S. citizens, matters to the U.S.
Yeah, it matters to everyone.
Right.
That kind of instability is it's not a good thing.
Yeah. Okay, so I'm going to let you go here, but before we do, give me the over under Fed funds rate at the end of 2025, 2.5%.
2.5. What is it now?
4.25.
Well, I mean, that's where the SOFR curve is looking. So I would say that I would take the under.
You take the under?
That's just the probabilities. In fact, you saw a huge wave of option trading just yesterday. So I don't know about today. I haven't really checked, but yesterday, massive amount of option trading that federal funds in the middle of next year are going to be much lower than even the current dots. So a lot of people are betting that the Fed is doing exactly what I said, which is the pendulum is swung back in the direction of dots going higher. And that when the next CPI comes in disinflationary and the next payroll report and the unemployment rate goes up officially as well as unofficially, the Fed will swing right back in the opposite direction, which is exactly what that's the process that we've gone through over the last year.
And CPI 2%. What do you think?
CPI 2%. I think we're less than 2%.
Under at the end of 2025.
Yeah, I mean, look, we're under 2% in a lot of places already. Key countries that are leading this downturn, like France and Germany and Europe, they're already well under 1% or under 2%. Under 2%. Switzerland cut by 50 basis points last week because their projections now are Swiss consumer price rates to be very close to zero. And they actually probably are negative because they moved them up based on the fact they believe the rate cuts will help stave off deflation. So you have a lot of these key places, and Canada's another one where consumer price rates have already fallen below 2%. So you're already seeing what economists and central bankers call undershooting. Undershooting is already started. It's not some future thing. It's already happening right now, which is one of the reasons why central banks around the world are cutting faster than the Fed. And that's another reason to doubt the Fed too, because these are globally synchronized cycles. If the Fed's the only one saying, well, we're going to go slow and take our time, while everybody else around the world is like, holy crap, we got to do 50s here. I mean, what really are the chances that this time is different and the Fed's going to go all by itself? It's just, it struggles for credibility.
Right. Okay. Last one, unemployment rate, 5.2%.
As the over under?
Yeah.
That's a tough one because there's a lot of, we're talking about official versus unofficial. Plus, we really don't know the degree of layoffs that are going to, and what would likely take place. It might be that the unemployment rate just goes to 5%, and that's enough. Just because, contrary to perceptions, businesses did not hire a lot of people in 2021 and 2022. I know we talked about everybody labor shortage and everything else, but you actually look at the data. The establishment survey is 4.2 million jobs behind the pre-2020 baseline, which meant that they didn't rehire as many workers as they should have.
And the household's worse than that, right?
What's that?
And the household's worse than that.
It's like 9 or 10 million. In terms of full-time jobs, it's 10 million off of baseline. So what that means is that businesses didn't actually staff up as much as they should have on the upcycle. And so they're running relatively lean operations, which is one reason why they haven't let a lot of people go. They can't. They're running basically bare minimum as far as employees go. And so why do you hold on to employees? Well, you can't fire them unless you absolutely have to. And so that's where the layoffs come in, is like, I really can't fire these workers, but I actually have to because business has fallen off that much. So that's why they haven't been hiring, because that's the cyclical aspect of it. but they didn't hire enough during the upswing, which means that structurally they have relatively lean operations to begin with. And most of the layoffs in any cycle are because they have more than lean. They've added too many employees on the up cycle. They can get rid of a lot of waste and excess and additional payrolls. So unemployment's a tricky one. And I have a little bit of sympathy for the Fed and Jay Powell in this respect, because we don't really know how lean operate, where's the trigger point for these businesses to say, we're already not hiring, but can we actually start firing people? So unemployment's a tricky one. And I think 5% is probably a good range where it really starts to get bad.
I would say, though, especially if you have a balance sheet recession, I would take the over on that, just because I think labor force participation would skyrocket, because people just flat out don't have a choice but to take any job that is available, because they can't pay the rent.
Yeah, and in that situation, you see wage rates go plummeting.
Yeah. Jeff, tell us about the sale you got going on with Eurodollar University. What is it? What's the sale about? Why should I join Eurodollar University?
We haven't already, George?
Well, I have, but I'm saying
Eurodollar University.
Anyone left out there that has not yet joined, give them the pitch.
Yeah, Eurodollar University subscription services Christmas sale coming up this weekend. It's actually more like an after Christmas sale. Subscriptions got deep dive analysis where we go into all the details, the background, the material, primary source, everything that you can imagine. Where deep dive into all of these topics. That's the subscription. We also have memberships available where we go into some of the basic stuff. What is money? What is a Eurodollar? What is a reserve currency? So there's memberships available. Also do a daily briefing, which is another subscription service. So best prices after Christmas on all Eurodollar University products.
Awesome, buddy. Awesome. I know you're pressed for time. I've got you up on the Rebel Capitalist Live sales page for I didn't even ask you, but
you don't need to ask, George. That's fine.
All right, there you go. It's Memorial Day. It's Memorial Day weekend. Okay, Jeff, enjoy the rest of your evening, buddy. We'll talk to you soon.
All right, thanks, George.
All right, guys. Now we are not done with this live stream. Oh no, we've got another topic of discussion to go over. That is Automageddon. And as I was saying that, I'm like, you know what I should have called it, Josh? I should have called it Carmageddon. Why did I not call it Carmageddon? That makes so much more sense. Why didn't you tell me that, Josh? That's your job.
Honestly, Automageddon sounds pretty good too.
You think so? All right. Well, let's get into Automageddon or Carmageddon. You decide which one is better. In fact, in the chat here, why don't you guys tell me which one you like better, Carmageddon or Automageddon? All right, let's get over to exactly what's going on here. Josh, I think we'll start with retail sales, because what's happening with the auto market is a big component of retail sales. And if we zoom back over to Market Watch, we see retail sales jump on strong auto. Now, this is the United States here. And this ties into what we were just talking about with Jeff Snyder and the probabilities that the United States remains an outlier. Okay. They say retail sales up, strong autos, and internet buying, economy in good shape for the holiday season. Okay. Yeah, on the short term, I don't disagree with that. We'll have to see how the numbers play out. But they say the numbers, there's no quit in the American shopper. So this, for me, I like to pause right here and just, you guys are in the States. I only go to the States maybe 5 or 6 times a year, but obviously I have a lot of friends and family there. And from what I'm hearing from my friends and family, they are not saying, everyone that I know is just completely flushed with cash. They are so rich that they don't even know what to do with all of this disposable income. They're like Scrooge McDuck, right? Just diving into the into the money, or just doing the backstroke with all the gold coins. That's not really what I'm hearing. And I'd like to know from you guys, and let me know in the chat or the comments below, are your friends and family members Scrooge McDuck right now? Or are they maybe pinching pennies, right? Or are they the opposite? Have they seen their purchasing power go down to the degree to which it's playing out, or it could play out in this bifurcated economy, very much like it's playing out in these other economies where the governments are collapsing. What I mean by that is we have this K-shaped recovery, trying to do a K there. Yeah, the people with asset prices, asset on their balance sheet, they're the ones that you see shopping in these stores and driving auto sales, no pun intended, or driving internet sales. When you have the bottom part of the K, well, they're in an economy where it feels a lot more like Germany or China or France, UK, Canada, something like that. And that's an increasing majority, which I think one of the main reasons why Trump was elected to begin with. But getting back to this, retail sales represents 1/3 of all consumer spending. Now, this was up 0.7 last month. I want to point out the fact this is not adjusted for consumer price inflation, which I think is completely insane. So if you look at year-over-year numbers, Josh, in fact, while we're discussing this, can you pull up year-over-year retail sales, including this last print that we had just yesterday, I believe, of 0.7% a month over month? Because I want to compare that to headline CPI and see if we're actually positive. I mean, we could be at a negative when you actually adjust for inflation. And so if you're a producer, what do you care about? You care about nominal retail sales, or do you care about real inflation adjusted retail sales? Obviously, the latter. Let's keep going down this article. We see key details, sales of new cars and trucks jumped 2.6% in November to lead retail charge. Now, what I'd be curious, they say sales of new cars. Are those units? Or is that price? Or is that like total revenue, right? Because just because the total dollars of autos or cars jumped by 2.6%, it doesn't mean the units increased, right? You could be fewer units sold, but just higher prices. So that's something that's important to really dig into the details. Restaurant sales are up a seat. There you go. Sales. This doesn't mean anything. Why are we focusing on this, for heaven's sakes? It says restaurant sales are up a decent 2%. But again, that's not how much people are buying. That's how much it costs, right? So if you have inflation running at 2.7%, which you guys know it's running a lot more. I'm just using headline CPI to be generous. If inflation is at 2.7% and restaurant sales are up 2%, they're negative. They're negative. I don't know why on earth are these numbers not adjusted for inflation. That's complete insanity. My little rant there. Okay, so let's look at this through the lens of the global economy, not just the U.S. domestic economy, so we can get an idea of what's happening. And if it is true what Jeff is saying about the global synchronization or the interconnectivity, we've got to pay attention to what's happening in places like Europe to predict the probabilities of a certain outcome in 2025. And this obviously applies to Fed interest rates, applies to the U.S. economy. It applies to the S&P 500. It applies to pretty much everything, and applies to dollar, which applies to liquidity, which applies to gold and Bitcoin. Let's shoot over to Twitter. And I just retweeted this from Michael Aro. I'm sorry, Michael, can't pronounce your last name, but he's always got some great charts, good data. Look at this. Look at this. Let's zoom in here. Volkswagen profits drop 64%. 64%. Oh, but wait, there is more. Audi profits drop 91%. 91%. BMW, 84. Mercedes-Benz, 54. So now you could be sitting there saying, George, this is nonsense. Again, it's the same old argument that this is happening in Europe, and therefore it's going to happen in the United States. I get it. I get it. But I disagree. This could all be just a representation of what's happening in China or what's happening in Germany. You know, obviously these are all German auto manufacturers. But I think the point that misses is it's not like Mercedes-Benz sells Mercedes-Benz just in Germany. Last time I checked, they sold a lot in the United States. They sold a lot in the UAE. They sell a lot here in Colombia, for that matter. Same thing with BMW, same thing with Audi, same thing with Volkswagen. So I get it, how this is more a representation of what's happening in Europe, in the Eurozone, but it's also, to a certain degree, a representation of what's happening with the underlying economy in the United States. And like I said here in the tweet, get back to it. Usually, auto sales are a good proxy for the overall health of the underlying economy. In this case, you could say the global economy, you could say the Eurozone, potentially, you could say what we might see in the US economy in 2025. Now, it's not to say that I'm predicting a 2008 or anything like that. I'm just trying to go over the facts as objectively as I possibly can, unlike Jizz in My Pants CNBC, to give you guys a more well-rounded view. So even if you think I lean a little bearish or a little negative, great. There's a lot of guys out there that lean way, way, way bullish. So you just take both of the arguments, you put them together, and use that to come to your own conclusion. But the last thing you want to do, and I am guilty of this myself, and I try not to do it, but the last thing you want to do is just live in this echo chamber of a specific narrative that you agree with and just continue to get that confirmation bias over and over and over and over again. That, as my good buddy Jim Rogers says, is a quick way to the poorhouse. All right. We'll have to wait and see what happens with the U.S. auto manufacturers. I mean, with the exception of, is it Stellantis? That was old Chrysler, wasn't it? I mean, I know they're in the toilet, but it seems like some of the others are doing okay. We'll have to see how that plays out over the next quarter into 2025. But we also have to make sure that when we see these sales numbers, we are also adjusting for inflation to really understand what's happening beneath the hood. No pun intended. I got some great puns today. Don't I, Josh? Great puns today. All right, guys, on that bombshell, enjoy the rest of your evening. As always, stand up for freedom, liberty, free market capitalism, and we'll see you in the next video.